When an American sets up a foreign trust, the only thing he needs to be concerned about is the reporting requirement. And again, anything and everything you do overseas, we'll discuss bank accounts in a second, is subject to very extensive reporting requirements. So for foreign bank account, for foreign trusts, you have to file a Form 3520 and Form 3520A. These forms get attached to your 1040, and they will provide the Internal Revenue Service with all kinds of extensive information on your foreign trust, which jurisdiction it's organized in, who is the trustee, what sort of assets it has, what sort of income it generates, and so on and so forth. So foreign trust can be very clever, very creative, very flexible planning tool in the right set of circumstances, and can actually produce amazing tax results in the right set of circumstances. So in this next section, we will talk about the tax consequences of an American having a foreign bank account. Right? So we've discussed the controlled foreign corporation rules, the income tax rules. Now you do have your business overseas, or you're making investments overseas. You need to be able to bank overseas. So you go to a bank and, in Zurich, you open up a bank account, either in your name or in the name of your foreign corporation. What are the tax consequences? Well, the substantive tax consequences of having a foreign bank account are really non-existent. It's just part of your business. It's part of what you do overseas. There's no separate tax that applies to having a foreign bank account. What does apply, though, are the tax reporting requirements that are associated with having a foreign bank account. And as of the past few years, these foreign bank accounts have become subject to very onerous and very exacting reporting requirements. So it used to be that if you have a foreign bank account, you have to disclose it to the United States Treasury. And if you fail to disclose the foreign bank account to the United States Treasury, what happens? Maybe there's a small penalty. Often it will not apply. It was rarely enforced, and no one really bothered with these rules that much. Plus, people thought, well, listen, I have a bank account in Zurich. No one will ever learn of this bank account. Well, why disclose it? So what started happening a few years ago, you probably have heard of the UBS case, where the United States was able to exercise some leverage over UBS, Union Bank of Switzerland, and get them to start handing over information on all of their U.S. clients. Switzerland failed to protect UBS. The Swiss Parliament sort of caved and told UBS, yeah, you have to provide information, effectively destroying the Swiss banking privacy and secrecy that has existed for hundreds of years. And emboldened by its success, the Internal Revenue Service and the U.S. Treasury started going after banks, other banks and banks in other countries. And later what came out of all of these developments with the UBS is a body of law known as FATCA. And FATCA really, small parts of it went into effect this year. The larger, more important parts will go into effect next year. But FATCA provides the following. If you are a foreign bank and you have a U.S. client, you have a choice. You will either provide the Internal Revenue Service with all the information you have on your client, including issuing to the client a 1099 and issuing to the IRS a 1099 on your U.S. client. And if you don't do that, any payment that you receive from the United States will be subject to withholding, very steep withholding. And if you can imagine, if you are a foreign bank, you may want to invest in stocks of U.S. companies, either for yourself or on behalf of your clients, in U.S. bonds, right? Maybe government bonds, what have you. So if the earnings you get from these investments are now subject to very large withholding, that really sort of ties your hands. You don't want that. You want to avoid that. So a lot of foreign banks, even before FATCA, simply because they were concerned with all the burdens that will be coming down the line from the U.S. Treasury, from the United States Securities and Exchange Commission, which has been demanding for years that foreign banks with U.S. clients become SEC compliant. They basically slowly started saying, we don't want U.S. clients. So we went from having literally a few thousand banks in Switzerland alone that would buy for American business, to having 2 banks in Switzerland that will accept a U.S. client. And the same has been happening all over the world. No one wants U.S. clients anymore. Singapore does not want U.S. clients. Hong Kong does not want U.S. clients. Very, very few countries left that willingly take a U.S. person with a bank account. And when FATCA goes into effect, what these banks will have to start doing, the banks that still have U.S. clients, who have maybe not kicked all of them out or who are still accepting business from the United States, is they will have to put together an annual report on all of their U.S. clients, you know, what bank accounts they have, how much money is in the bank account, what sort of earnings they've had for the year in the bank account, and give all of this information to the U.S. Treasury. Or if the country that the bank is in has signed an agreement with the U.S. Treasury, then the bank in the foreign country can provide all of this information to their central bank, which will then hand it over to the U.S. Treasury. So, for example, a lot of the bigger European countries, you know, France, Germany, UK, have entered into these agreements with the U.S. Treasury. So all the UK banks will provide information on U.S. clients to the central bank in London, and then the central bank will provide it to the U.S. Treasury. It doesn't mean that, all of this does not mean that having a foreign bank account is illegal. All of this does not mean that it's a bad idea to have a foreign bank account. And frankly, there's so many U.S. Taxpayers, so many U.S. businesses that engage in business transactions overseas, and they must have bank accounts, right? Not all foreign bank accounts are set up for nefarious reasons. Sometimes it's just, you know, you need a bank account to run your business overseas. But all of this will become to very strict reporting requirements. So we really very strongly urge all of our clients to make sure that they comply with the reporting requirements. Penalties have been very severe as of late. You know, the Internal Revenue Service is now going after undisclosed foreign bank accounts and trying to put people in jail for not disclosing their accounts and income. There was a case I read just a few weeks ago about a woman in her 70s who inherited a foreign bank account from her client. She had it for a few years. She either did not know that she was supposed to disclose it or chose not to, didn't tell her accountants about it. She's now in jail. And it's insane, you know, if you think about that this is happening in the United States, it's, you know, Gestapo at work. But, you know, that is the environment we have today. Anything to do with overseas is immediately and automatically pursued as being aggressive, tax abusive, and subject to very strict reporting requirements. So we do encourage clients to disclose and report anything and everything they do overseas. The second subject that I want to talk about for the remaining 10 minutes is expatriation. And then after expatriation, we will move on to inbound taxation, which is how foreigners are taxed when they come in to the United States and do business in the United States. So what is expatriation? Expatriation is the act of surrendering U.S. citizenship. So why would someone surrender U.S. citizenship? And then, because this is a tax presentation, what are the tax consequences of surrendering U.S. citizenship? Well, the act of surrendering U.S. citizenship is fairly straightforward. You know, you go to the Department of State if you happen to be in the United States, or you go to U.S. consulate or embassy if you happen to be overseas, and there is a process of, you know, handing in your U.S. passport and say, I'm done. I no longer want to be a U.S. citizen. Your citizenship will be torn up, so to speak. Your passport will be destroyed, and you're no longer a U.S. citizen. So we have seen clients who have done this for political reasons. Who was it? I think the first time Obama was running, no, not Obama. When Bush was running against Kerry, was it Alec Baldwin who promised to move to Mexico if Bush wins? That would have been expatriation if he actually honored his word, but he's still here, but that's a different subject. So we've seen people do this for political reasons. So for example, every time there's an election, we will have clients who come in and say, a Republican got elected, a Democrat got elected, we are fed up with this country, we're moving out. Okay. We've had clients who say, you know, we're so concerned about how there's less and less privacy in the United States and less respect for individual liberties. We want to move to a country where we will have our privacy and liberty. And of course, often people do surrender U.S. citizenship purely for tax planning purposes, which is kind of interesting. So first of all, if you are going to surrender U.S. citizenship, are you going to be like Tom Hanks in that movie, you know, where he's living in the terminal because he doesn't have a passport from any country and he can't cross a border? So before an American surrenders citizenship, before an American expatriates, he has to make certain that he does have a citizenship in some other country, right? So there is a whole now cottage industry that has come into existence to get what's called a second passport, to get a second citizenship. So this would mean that an American would go to a foreign country and usually for some sum of money purchase citizenship. And you know, when people hear this first time, it sort of shocks them that you can purchase citizenship. Well, the concept and the system of what's called an economic citizenship has been in existence for a long time. It exists in pretty much every single Western European country. It exists in the United States. It exists in most Caribbean nations and many other countries. It's just we don't hear about it commonly, so you know, we're not aware of it. But even in the United States, there is a concept of economic citizenship where a foreigner can come to the United States, invest a certain amount of money, you know, create a certain number of jobs, and he will be given permanent residence and therefore a path to citizenship after 5 years. In the United States, in Western Europe, to gain citizenship, economic citizenship, it's usually a fairly significant investment. I mean, it varies from country to country, but if you want to become a citizen of Italy, you need to invest, you know, from I think 500,000 to €1 million with an Italian bank for at least a year or 2 years. If you want a Latvian citizenship, it's just a $200,000 acquisition of an apartment in Latvia. But if you want to become a citizen of one of the British Commonwealth jurisdictions in the Caribbean, it's usually fairly inexpensive. And there are jurisdictions where between $150,000 to $250,000, you basically get their passport. What I usually advise my clients when they're trying to pick which country they will buy citizenship from is not to focus solely on the cost. Yes, of course you want to save money, that's understandable. But sometimes you may want to pay a little bit more to get citizenship from a different country. Why? Because this will now become your passport. This will now be the document that will allow you to travel the world. And different countries may have a different amount of visa agreements or no visa travel agreements with countries. So for example, if you maybe get a passport from Angola, there is no other country in the world that will accept you without a visa, and getting a visa on an Angolan passport may not be that easy, right? But if you get a passport from Nevis, let's say, or from Dominica or one of these other countries, you know, these are all British Commonwealth jurisdictions. So right off the bat, every British Commonwealth nation, Canada, UK, Australia, New Zealand, all the Caribbean countries, do not require you to have a visa to travel there. And getting visas to other countries may be actually a bit easier because it's a British Commonwealth jurisdiction. So first part of expatriation is to make certain that the client has that second passport before he surrenders his U.S. passport. Now, the client is ready to surrender U.S. passport. Again, the actual act is fairly simple and straightforward, but before the surrender will be accepted, the client must present to the Department of State a clearance letter from the IRS, where the IRS basically says he paid all his taxes, he can go. Because once someone leaves the United States, the U.S. will have a very difficult time collecting whatever tax liabilities may exist. So they want to make certain that all unpaid taxes have been paid. The expatriation tax regime has been changed in the past 3-4 years. And the new tax regime that is in existence today is what's called the MarktoMarket regime. And in the MarktoMarket regime, all of the assets that the expatriate owns anywhere in the world are deemed to be sold on the day of expatriation. And if the assets are deemed to be sold, what are the tax consequences? Well, the tax consequences are actually fairly straightforward, right? If you sell an asset, there's a capital gain. you pay capital gain tax on the sale of an asset. If you owned an asset for less than a year, ordinary tax rates would apply. So for clients who are looking to expatriate, the planning can be twofold. One is we want to maybe position them to a place where most assets do not have built-in gains. So over the years, the client converts out of assets with gains into assets that have no gains. Or maybe the assets that will be marked to market today have a lower value than they will have tomorrow. And one of the founders of Facebook, and I always forget his name, engaged in exactly this sort of tax planning. He was a dual citizen, I think, of Singapore and the United States. And before Facebook went public, he surrendered U.S. citizenship. And before Facebook went public, his stock was worth, I don't know, let's say $50 million. I'm just picking a number. After Facebook went public, his $50 million stock was now worth, let's say, $500 million. So if today you surrender citizenship, and today the stock is marked to market, meaning it is deemed sold, it's sold at $50 million. He pays the capital gain tax as of that number, surrenders U.S. citizenship, moves to Singapore, still owns the stock, right? And now when the stock goes public, it's worth a lot more money. And if he sells that stock for a lot more money, it's a capital gain. He is a foreigner. Foreigners are not taxed, as we'll discuss in the next segment, are not taxed on their capital gains from sales of U.S. stock. So expatriation is it's an interesting process. There's some very interesting pre-planning that can take place for expatriation. And really it is all about what is the value of the assets, how much capital gain do we have, and when do we sell them, and how do we get rid of them.
The course code is 547. The course code is 547.
Now let's switch gears entirely and talk about inbound taxation. And inbound taxation is a completely different set of rules. Inbound taxation deals with how foreigners are taxed when they do business in the United States. So let us say that we are representing a client who is Chinese. He's a citizen and a taxpayer in China. He's a resident in China. He does not live in the United States, but he wants to maybe buy real estate in the United States. He may want to enter into a joint venture with an American company to pursue a business opportunity here. So what sort of tax consequences will this Chinese national have in the United States? Meaning, how does the United States tax this Chinese foreign national? Well, the answer, as it usually is, it depends, right? It depends on what he does in the United States, what sort of income he generates, and how he structures his investments. So if our Chinese national is an individual engages in business in the United States will tax him just like it taxes every other U.S. taxpayer, meaning the Chinese national will have to file a tax return in the United States, declare his worldwide income, and will only be taxed on his U.S. income. But the United States requires him to disclose his worldwide income so that all of the expenses and deductions can be properly apportioned between U.S. income and worldwide income. As you can imagine, most foreigners are very reluctant to do that. So for example, we represent a lot of foreign politicians who may be investing in the United States, Russian oligarchs, wealthy people from South America who are afraid of physical violence like kidnappings. Oftentimes these people want to keep their affairs as private as possible. The last thing they want to do is to file an income tax return with the United States. And in a lot of these countries where political systems and government agencies are very corrupt, we have these foreigners who believe that the United States is just as corrupt, and who knows, maybe to some extent we are, and who believe that, yes, they file an income tax return and for the right price, it will be available to their competitors or whoever. So, usually foreigners do not want to do business in the United States in their name directly because they do not want to be the one filing a tax return. That problem is usually solved by forming a forming a U.S. corporation for the foreigner, right? So our Chinese national will form, let's say, a corporation in Delaware, or it can form a limited liability company in Delaware that is taxed as a corporation, right? We check the box to tax the LLC as a corporation. And through this entity taxed as a corporation, the business will now be pursued in the United States. And now if you look at who has to file an income tax return in the United States, it's not the individual from China, it's now this Delaware corporation. And the Chinese national is just a shareholder. And being a shareholder in the U.S. corporation, you're not deemed to be doing business in the United States. And if you're not doing business in the United States, there is no requirement to file a tax return in the United States. What if the foreign national is not doing business in the United States? Let's say we have a Russian client who buys simply real estate in California. Well, first of all, even ownership of real estate may be equated to doing business, right? Because this may be actively managed real estate. But even if it's a purely passive investment on a triple net basis, there are certain tax consequences, right? To the extent that the foreign national engages certain types of income in the United States that are not from the operations of a business, whatever income is generated in the United States, it will be taxed to a flat, will be taxed with a flat tax of 30%. And the tax is withheld at the time of payment. What does that mean? It means that, let me give you a common example. Well, even with ownership of real estate, our client is an owner of an apartment building in New York City. The apartment building is generating rental revenues, right? Maybe someone is managing the apartment building. So, there's a property management company that is collecting the rent, paying the expenses, and then whatever is left at the end of the day, they want to send it to the Russian who owns this apartment building. Well, they can't simply send 100% of the earnings to the Russian owner of the building. They have to withhold 30%. Because now you have a payment that goes to a foreigner that is subject to this 30% tax, again, that is withheld at the time of payment. So if you're a foreigner generating interest income, dividends, rents, royalties, salaries, all kinds of income in the United States, if it's not connected to the operation of a business, this income is taxed at a flat rate of 30%, and the tax is paid at the time you get the money. Meaning whoever pays you this interest, dividend, rent, royalty has to withhold 30%. And they will withhold 30%, because if they do not withhold the 30%, guess what? They will be personally liable for the payment of the tax. Okay? There are favorable rules in the United States for foreigners in the following sets of circumstances. Foreigners are not taxed on interest they earn from deposits in U.S. banks. So if you are a German and you open a bank account with Citibank in New York City and the bank account generates interest income, you're not taxed on that interest income. It's a wonderful result for you. So the United States is trying to encourage foreigners to invest in the United States. If you generate a capital gain in the United States, you're not taxed on it. There's an exception for real estate. We'll talk about that in a second. But every other capital gain means you sold an asset and you've generated a gain on the sale of the asset. Shares of stock, furniture, intellectual property, it doesn't matter what the asset is. You sell an asset, you generate a gain, the difference between the sale price and what you originally purchased for. You're not taxed on that difference. U.S. taxpayers are taxed on it. A foreigner would not be taxed on it. And finally, if the foreigner gets paid on what's called a portfolio interest loan, I'll explain what that is. There's no tax and no withholding on this payment. And this is a wonderful planning structure. So a portfolio interest loan is simply a loan that is payable from within the United States to someone overseas. And this loan simply has a provision that provides that the loan payments can only be made outside the United States. So they always have to be directed to a foreigner. They can never be made inside the United States. Simple provision. So let's say my client in the United States borrows money from his business partner in Taiwan, and he makes interest payments on the loan. Well, if this is an ordinary loan, every time my client makes an interest payment, guess what? He has to withhold the 30% and pay it over to the Internal Revenue Service. But into the loan agreement, the parties insert this portfolio interest language, which is statutory language, like 2 sentences, very simple. Withholding is now no longer required because now there is no tax that the foreigner is subject to on the interest income he receives from the United States. So it's absolutely wonderful tax result, and a lot of transactions can try to fit into the portfolio interest rules. Even if it's nothing to do with the loan, we sometimes cleverly try to disguise equity participation as portfolio interest loan with, let's say, an equity kicker. For real estate, foreigners are subject to a separate tax regime known as FERPA. FERPA stands for Foreign Investment in Real Property Tax Act. And FERPA provides also for a flat tax of 10% on the sale of real estate that must be withheld at the time of the sale. So anytime a foreigner sells real estate in the United States, 10% gets withheld, handed over to the Internal Revenue Service. So that's sort of the basics of how foreigners are taxed in the United States for income tax purposes. But income tax is not all. In the United States, we also have gift taxes, we have estate taxes, cigarette taxes, property taxes, excise taxes, every kind of tax imaginable. So for foreigners, the other most important types of tax, other than the income tax, will be the gift and the estate tax. So the estate tax applies if a foreigner owns assets in the United States and then he dies. And the estate tax is imposed on the assets passing to the heirs, to the younger generation. Right? So let's say our client from France bought a home in Los Angeles, and the home is in his name. He dies. He dies in France. He lives in France. He's never actually been to the United States. He dies in France and leaves this home to his child, who also lives in France. We don't know why he bought this home, but that's not important. He has an asset in the United States. Well, the U.S. estate tax will apply to the transfer of the home from the parent to the child. And the estate tax will apply at the rate of 40%, meaning 40% of the value of the home will now go to the U.S. government. U.S. taxpayers are able to exclude from the estate tax $5 million of assets, meaning I can leave to my child $5 million before the 40% tax applies. Foreigners don't get that exclusion. They get to exclude only the first $60,000 of what they leave to their heirs. So if we have foreign clients who own assets in the United States, we do not want them to own these assets in their name directly. Because if they own assets in the United States in their name directly, on death, the assets will be subject to the estate tax. So in a case like this, what we want to do is we want our foreign client first to form a corporation overseas. And through this overseas corporation, to own the real estate in the United States, to own the limited liability company in the United States, to own whatever it is he will own in the United States. Because if he owns these assets through a foreign corporation, a non-U.S. corporation, then when he dies, what is the asset that he owns? Well, it's a share of stock in a foreign entity. It's not subject to U.S. taxation, not subject to U.S. estate tax. So it's a very simple way for a foreigner to defeat the application of the U.S. estate tax. There's a lot to planning for foreign investment in the United States. There are probably 12 to 15 structuring combinations that are commonly used. Does the foreigner own assets directly? Sometimes, maybe that's a good idea. Through a corporation, through an LLC, is there a foreign entity? Does the foreign entity own the U.S. entity? And so on and so forth. There's many different permutations of how that is structured. There are several other types of tax that apply specifically to foreigners when they invest in the United States, like the branch profits tax, a very onerous tax that we really want to plan around. So the basic rule that I want you to carry out today, both for outbound and inbound taxation, is that you get some very amazing results whenever you engage in income tax planning for cross-border transactions. You just need to plan a bit in advance. With some proper pre-planning, you can get very amazing results. You can get tax deferral if you're an American investing in the United States. And if you're a foreigner investing in the United States, there are many ways to avoid tax withholding, to avoid the application of the estate tax and minimize your income tax exposure, to keep your privacy and liability protection.